So, hi guys, welcome back. Today we're going to be looking at SoFi Technologies. We've covered this company quite a few times over the last 3 to 4 months. We've seen these companies through its highs and lows, and over the last 2 days, the stock is up more than 12% after one of their competitors released very strong earnings, and it's expected that SoFi will release the same in their upcoming Q3 earnings. So, today we're going to be looking at analyst expectations for their Q3 earnings. We're going to be looking at their expectations for the Q3 earnings. We're going to be looking at some analyst a stock analysis done. We're going to be looking at some catalysts upcoming. We're going to be looking at the exact benefits of a bank charter. We're going to be looking at some risks and then finishing it off with a bit of technical analysis, and I'll wrap up in the video. If I remember later on, there should be timestamps in the description if you want to skip ahead or what you're looking for in this video. So if you do enjoy, consider subscribing. It is free and it does help me out a ton. If not, thanks for watching anyway. On to the video. So the first thing we're going to be looking at is their featured presentation, where they look at their Q3 2021 non-GAAP guidance. On the low end, they're expecting an adjusted net revenue of $245 million compared to a high of $255 million, which gives them an adjusted EBITDA of negative $7 million to a positive $3 million, which gives them a margin of negative 3% or positive 1% on the high end. So we can see, and we're going to be looking later at some analyst expectations of the last 3 months when the moratorium on student loan and rent was extended. And because of that, it will hurt SoFi's margins slightly, and we can see that reflected in analyst expectations 3 to 4 months ago. But now coming closer to Q3, it is once again trending higher, and a lot of analysts are saying buy. So the first thing we're going to be looking at is just some analyst expectations. So if we look at the estimates of the quarterly numbers, just wait for this to load. Yep, so if we look at some of the estimates, here, we can see for Q3 of 2021, on the high end, they're expecting negative 4 cents, and on the low end, they're expecting negative 31 cents, and which gives them about an average of negative 14 cents, and Q4 of 2021 is once again similar with an average of negative 15 cents. We can see 3 months ago, there were only 2 buys and 1 overweight rating. 1 month ago, there was 4 buys, 1 overweight rating, and 1 hold rating, and currently we have 5 buys and 2 holds, which is overarchingly very positive to this stock. We're looking at some stock price targets. On the high end, people are saying it's worth close to $30. On the low end, they're saying it's worth close to $16. And currently, the median is about $25 right now, where the current price is $24. With the average being $24.58, with the current price being $22.62, showing it's quite undervalued compared to the Market Watch analysts and what they believe SoFi will be looking at in the future. If we look at the financial year 2021 EPS estimate trends, you can see it is trending lower because they are spending a lot on advertising and gaining new customers, but in the long run, we can see this benefit them there as well. And we can see overall, looking at analyst ratings, look at the quarterly numbers, and going back to what SoFi was looking at in Q2. Q3 does seem to be quite healthy for them, and they are expected to hit earnings or beat them if possible, and that will be a very good time to maybe do some options or buy the stock because it will be quite volatile. So the first thing we're going to be looking at is some analysts written by David Gordon. This will be looking at the competitive landscape of SoFi. It operates in the financial services industry as an all-in-one digital bank. To understand its business model, you must differentiate between traditional banks and neobanks. So traditional banks are physical checking account issuing financial intermediaries, while neobanks operate digitally without physical locations and have very few tangible assets. So SoFi is a neobank, so comparing them to Bank of America or Capital One wouldn't be right. Instead, they should be compared to other neobanks like Chime, Stash, or Acorn. So according to Bloomberg Research, SoFi is the 5th largest neobank in the US by member count. However, although it has fewer members compared to Chime and Stash, the quality of SoFi's members is higher. So what this means is that it allows them to market multiple financial products to members, and according to Bloomberg Research, 45% of SoFi members use more than one of its services. So SoFi's comprehensive offerings are the core of its competitive advantage within the digital banking market, and its ability to offer multiple services to members ensures the revenue per member increases, and it also makes SoFi's platform sticky for users and very effective for customers as a whole. Another key to SoFi's outperformance is that it has its loan offerings. So SoFi is the only major digital bank to offer loans to its members, which is a crucial differentiator in a highly competitive industry. SoFi's loan services have relatively high yields without banking fees, making SoFi a best-in-class option for consumers looking to take out student loans or refinance at a very attractive rate. So the next thing we're going to be looking at is some of their growth catalysts. So there are three main growth catalysts that David Gordon believes that will drive SoFi stock higher: their bank charter approval, the successful niche positioning, and their demographic tailwinds. So the first key growth catalyst for SoFi is the approval of the banking license, and I'm sure you heard this all over Google, all over YouTube, or a lot of stock picks. But today we're really going to delve into what it means, on what banking license can actually offer to SoFi, how good it can be for this company. That'll be slightly later in the video. So according to Bloomberg Intelligence, if SoFi is granted a national bank charter, its EBITDA margin could jump as much as 15 percentage points in year one, with a cumulative $1 billion in EBITDA added through to 2025. Not only will a bank charter improve the economics of SoFi's business by significantly increasing its margins, it will also further widen the company's economic moat by differentiating its offerings from competitors. And a national bank charter means SoFi would have the ability to offer potential members increased deposit options without fees, a combo no other digital bank can match. The second growth catalyst for SoFi is its niche positioning within banking. A great company can find an unmet need within the market and fill that need, and that's what SoFi is doing. SoFi's strategy is to attract low-risk, high-income Americans who feel undeserved by traditional banks is the key to its long-term success. No other bank has fee-less offerings and competitive yields, combined with financial services ranging from student loan refinancing to crypto trading. So overall, it ticks almost all the boxes when it comes to product expansion. The final major growth catalyst is its powerful demographic tailwinds. The US is on the cusp of a dynamic shift in generational wealth, with the shift from baby boomers to millennials, and the company best positioned to benefit from this profound megatrend will dominate the financial service sector for decades. According to the Federal Reserve data, millennials can currently have 3% of total US wealth, but the number could grow to 30% over the next decade, according to research from Deloitte. Even as projections show, millennials will be the most dominant or one of the more dominant wealth holders in America, and few banks adequately service the needs of wealthy young Americans. Another major problem for young Americans is a lack of credit history necessary to get loans, and SoFi aims to solve this problem and fill the current age service gaps in the banking market. Bloomberg's research shows that 250 million Americans bank with the top 10 traditional banks, and SoFi aims to target 75 million bank customers who earn over $100,000 in annual income, drastically increasing their market share and becoming more competitive on the national and then maybe later on the global stage. The next thing we're going to be looking at is really diving into the bank charter effects and what this really means to SoFi. This is written by Christopher Hoger, also on Seeking Alpha. So the first thing is margins. So the effect of SoFi's margins is the easiest to quantify. Owning a bank charter allows SoFi to use their deposits to finance their loans. Lending is SoFi's biggest source of revenue and profits, and right now they have to borrow money from third-party banks to finance the majority of their loans. These third-party banks charge somewhere between 2 to 2.5 interest rates or 200 to 250 basis points to use their money. As soon as SoFi obtains a bank charter, they can use the deposits from their members to finance those loans, and this means the cost of capital goes from 2% to what they pay their SoFi Money members in interest, currently 0.25%, but more on that later. This improves their margins. Additionally, answering to and being regulated by a single entity, the OCC, is easier than being independently regulated by 50 individual states, which is what SoFi currently has to do, and this cuts down administrative costs. And most people are familiar with the following slide from the investor slide deck, but it's worth looking at here as well. The illustrative impact of a bank charter, we can see that their potential adjusted EBITDA from a bank charter will increase by 2025, and their base case adjusted EBITDA will also increase. And this increases their durability, it will lower their cost of capital, increase NIM from holding loans longer, and enables increased growth in lending. So EBITDA is a measure of earnings. Dark blue bars are the earnings without a bank charter, and the light blue bars are incremental earnings they get because of their expanded margins. So in simpler terms, in between now and 2025, the bank charter is worth about $1 billion in profit margin, with based on current revenue. Profitability, free cash flow, cash on hand, and the whole host of important financial parameters will get a big boost from the bank charter. The second one is marketing. The second key aspect about the bank charter is that it allows SoFi to have more effective marketing. A national bank gives them legitimacy. SoFi money deposits are already FDIC insured, but that is through partner banks. As one of the first fintech companies with a bank charter, SoFi will have a cachet and credibility that will help them stand out from their peers. That credibility and legitimacy is all well and good, but when people are making a financial decision, the most important factor is how it affects their wallets. That brings us to the third one, is personal loan. When you type in personal loan into Google, the first website that pops up after the paid advertisements is Bankrate's website, and it looks something like this. So you have the lending partner, their APR, the term, and the max loan amount, and then you can see their offers on the side. You'll notice that SoFi is among the top results, so that's over here. And their product offering ties for the lowest APR, the most flexible terms, and the maximum loan amount. What would happen if they dropped their APR by 0.25% or 0.5%? Anthony Noto gave an interview about the effects of the bank charter, and speaking specifically about loans, he said, my cost goes from 2% to 15 basis points, and I could give that all back to you in a lowest interest rates on the loan, or I can help you a higher interest rate on your deposit, or I could drop it to the bottom line. So we'll do a combination of these things. That means they will be more competitive. They can gain more customers by having higher interest rates on deposits, or they can have more profit and reinvest into the reinvest back into the company, which is all really, really good things for SoFi as a whole. So we'll do a combination of those things. In other words, there are three things that SoFi can do to lower their cost of capital. They can use the lower APR on the loans they offer, they can give a higher interest rates to SoFi money accounts, or they can use it to improve their margins. According to Noto, they plan to do all three. SoFi already has such low costs that they are being tied to the lowest cost provider with their current cost of capital. After the bank charter, SoFi can simultaneously drop their APR to attract more customers while still expanding their margins. If you're looking now for a personal loan that you find at the Bankrate page, but SoFi's APR is 4.75 or 4.5%, that is certainly going to be the first link you click. And SoFi would have obviously gained another member into their sticky system. And that brings us all the way back to what we were talking about earlier, how SoFi has very high quality members, meaning that once they get a member hooked, they can attach that member to a lot of other services that they provide, increasing their revenue per customer. Once again, very good for the company, but also keeps the customer towards the company and less likely them to switch to a competitor. The fourth one is student loan refinancing. So let's do the same thing with student loan refinancing. Again, you can see SoFi is not exactly here, but it is being, here it is. So SoFi is being tied there, and it is being tied to the lowest rate available. If they use a portion of their lowered cost basis or even try to offer better rates, they will hoover up an even greater portion of the student loan refinance market. The other one is SoFi Money. The second option that Anthony Noto mentioned was that SoFi can give you a higher interest rates on your deposits. This is in reference to a SoFi Money account, which is similar to a checking account. Currently, SoFi offers a 0.25% interest rate on the balance in the SoFi Money account. But because SoFi is not a nationally chartered bank, they have to send your deposit to a third-party FDIC insured bank. Once SoFi has their bank charter, they're free to give their member whatever interest rate they choose. The best high-yield saving account in the market are currently giving between 0.5 or 0.6% APY. So SoFi can easily disrupt the market by offering a better product and a better interest rate. As I mentioned before, SoFi's money is akin to a checking account. It is liquid, and you can spend the money in the account with a debit card or withdraw funds from an ATM. These high-yield savings accounts do not have the same liquidity. To access the money, you first need to initialize a transfer to a checking account, which typically takes 3 to 5 days. Banks can do this on purpose to increase friction between you and your money in these high-yield accounts so that you move it less frequently. Anthony Noto is on the record as saying that this practice is not necessary in the modern banking world, and SoFi will be able to offer an account that gives you flexibility of a checking account with the interest rate that surpasses high-yield savings account as well. And this will incentivize their members to move a large portion or almost all of their money into SoFi Money account. And the total value of the deposits, the better their lending margins can be, and this can go once again into a cycle, growing the bank very, very healthily. However, it is not without risks. So the second last thing we're going to be looking at is the risks with SoFi. So the lack of commercial mode is a long-term challenge for SoFi. SoFi is poised to improve customer monetization as it expands its services and increases its cross-selling potential, but customer retention will become more of an issue for fintech companies in the future. The market is set to get a lot more competitive once the low-hanging fruit is gone and the market saturates. Other fintech rivals pose a threat to SoFi's customer acquisition and monetization plans because barriers to switch are low and financial companies compete chiefly on margins, and this generates revenue and profit risk, which may result in lower sales multiplier factor for SoFi in the future. However, once again, tying to what we talked earlier, SoFi does have quite a lot of services that they can tie their members to, which kind of shields them from the risk of being taken away by competitors, but it is always a risk in a very small company, a growing company in a very, very competitive market. The last thing we're going to be looking at is just some of the technical analysis. You can see the stock has been quite volatile since the beginning of 2021, and it has recently surged, going all the way from about $13.50 to about $22.50. So if you look right now, the last day or two, the stock surged about 12%, and it's trading quite higher than their 20 or 50-day simple moving average. So I wouldn't recommend. I entered the market with this stock closer to $18 when it was closer to its 20 and 50-day simple moving average a while ago, and a lot closer to its 200-day simple moving average, which made it quite a safer bet, especially for a volatile stock. So once again, I feel like the stock will correct over the next few days because the earnings are coming up and the stock will be quite volatile. I wouldn't be surprised if the stock drops about maybe 3 or 4 percentage points before that, and that could be a good time to enter the market if you do believe they will surge in quarter 3. And based on their current earnings expectations, that does look like a possibility. Another thing that you could do is maybe do some straddle or strangle options, where you buy both a call and a put at the same ticker price or a slightly wider ticker price, and you can profit whether the stock goes up or down, because I'm pretty sure that because the stock is quite volatile right now, even a slight beat in earnings could send the stock flying up, or a slight miss in earnings could set the stock tumbling down. So that could be another game that you could play, looking at the upcoming earnings, and maybe try to make a profit both ways if that's possible in the short term. So that brings me to the end of the video. Once again, today we covered their quarter 3 earnings, analyst expectations. We looked at some catalysts. We looked a deep dive into the benefits of their bank charter. We looked at some risks and a little bit of technical analysis and some options that you could do with this company. That brings me to the end of the video. If you do enjoy, consider subscribing. Let me know what you think of SoFi, and I'll see you in the next video. Thanks for watching. Bye.